Ladies and gentlemen, thank you for joining and welcome to the panel discussion on the future of investing in the era of longevity. This event is organized by London Business School, Women in Business Gulf Association. My name is Wulan, and I'm here with my fellow board members, Suma, Natalie, and Omar, also Anissa and Leila. The rising life expectancy means that we will live up to 100 years or more. However, are we prepared for it from a financial point of view? Is our investment lucrative enough to cover us beyond the typical retirement age? We will discuss about how the investment landscape has changed drastically over the last 10 years and how the future will look like with the introduction of cryptocurrency, NFTs, and much more. Now, a bit of housekeeping. Please keep your microphones off unless you are speaking. You can, of course, keep your camera on if you wish. We have Q&As at the end of the session, so please keep on sharing your questions in the chat box, and please mention who the question is for. Finally, we are recording the session and we'll share a copy of the recording on our LinkedIn page after the event. Now, I will hand it over to our moderator for the day, Rawat Khalife, to get started and do the intro. Thank you.
Thanks a lot, Turan, for this intro, and thanks for LBS, specifically the Women in Business Association, for organizing this session. And thanks for also everyone joining in this evening. Hope you're gonna walk away with some good insights about the future of investing and how best to allocate capital into which assets. So I'm Rawat Khalife. I'm startup operator, worked at a couple of startups here in the region, and then turned into the VC space, and I joined the MEVP, where most recently I was executive director there. And particular sectors of interest within VC, like I looked a lot at marketplaces, B2B SaaS platforms, as well as fintech generally. That was like a specific passion of mine. Looked a lot at wealth tech, personal finance, and all sorts of whether consumer and business B2B like type of fintech platforms. So also I'd like to say welcome to, we have a great set of panelists tonight, and we're gonna be having Nadine Mizher, which is co-founder at Sarwa, Rachel Peter, who's advisor at Skybridge Capital, and James Prince, who's the CEO and founder at Prinden. I'd like to perhaps start off with maybe like a bit more detailed intro from each of the panelists. Maybe we can start with you, Nadine, a little bit like introducing yourself to the audience.
Sure. Hi, everyone. So my name is Nadine Mizher, and I'm one of the co-founders at Sarwa. Sarwa is an online investment platform. What we do is we help people invest in international markets via a very simple to use app, very low cost, very accessible, very affordable. So our aim was to really make investing as democratized as possible and to bring it to the mass. I've been here for 14 years in the UAE. My background is quite multidisciplinary, worked across different industries, and I would say the bulk of my career has been in retail strategy. And yeah, and then I co-founded Sarwa with Mark and Jad 4 years ago.
Okay. Great, thanks Nadine. Over to you, James.
So a similar space really in the wealth management. The last 11 years I've been here in the UAE and advising individuals, and it's more of a face-to-face advisory role. And the whole concept and idea of Prinden is to help our clients reach financial freedom, and that being that their passive income coming in from their investments is the same or greater than their outgoings. That's what our definition is. And we do that through 3 different methods of investing into markets, investing into real estate as investment, and also investing into businesses. So we kind of have a holistic way of investing and diversifying to give the client the financial freedom.
Thanks, James. And Rachel, if you can have please like a few words for a quick introduction.
Sure, thanks very much. And it's good to see familiar faces on the call today as well. So I'm Rachel, I'm a senior advisor to Skybridge Capital, and we're a bit more specialist than Nadine and James. So we're an alternative investment manager based out of the US, but I'm here in Abu Dhabi. And like Nadine, I've been here 14 years as well. And Wulan mentioned in the introduction about some of the new themes, two of them being cryptocurrencies and NFTs. So we're about a $7 billion investment manager, and currently we have about $1 billion in cryptocurrencies. So this is an area we've been studying for some time, but I think everyone is far from being an expert in it because it's still so new. And yeah, previously I worked with Mubadala, one of the sovereign wealth funds here, in their capital markets and treasury team.
Perfect. Great. So maybe let's move on and talk a bit more about risk appetite and general investor behavior. I'd like to ask everyone in the audience, starting with James, like, how has investing changed over the last 10 years? Like, what should we invest in? What are really the good investment options and general investment themes?
I think it's a great question, and it's changed. I think it's changed more in the last 10 years than it probably has in any other decade in the last 100 years. Customer behavior has changed a lot. I mean, back in the day, when I think about my dad and granddad, they always used to get the information from the back of the Financial Times and be able to pick stocks, but you then call your broker or you call your bank, and that's all you had access to. Whereas now everything's digital and immediate, which has advantages and disadvantages to it, because that's one of the reasons why I believe markets are a lot more volatile, because you've got the end user, which is going in and out of markets more rapidly, more frequently, as opposed to before. There just weren't them levels of availability. So it was just different. So there's been a lot of changes, and I think it's going to continue to get quicker, more direct in the future as technology, improves.
Excellent. And what do you think, Nadine, about how has investing changed, especially like in the last 10 years?
No, yeah, I completely agree with James. I think, it used to be that wealth was reserved for the wealthy, and to actually be able to grow your wealth, you need to have money already. And that's changing drastically with technology, with the adoption of technology, and the fact that, now you have a lot of these tools that allow anyone to have access to whatever was reserved to very high net worth individuals. So it's changing very, very quickly. And I would say the pandemic even made it much more exponential. And we're seeing globally, but even more so regionally, a complete change in consumer behavior. And I think technology is at the forefront of that. And we're going to see a lot of new assets also coming into the market. And I don't see the adoption of trading apps and investment apps changing or slowing down. I think it's going to be increasing.
Excellent. And would love to get also your thoughts, Rachel, on that.
Yeah, sure. I mean, I guess I love that point that Nadine made about wealth being reserved for the wealthy. And I guess the themes that are sort of driving that, you've had the rise of passive investing, you've had the rise of retail investors, and then you've obviously had the rise of like technology and robo-advisors. And I think, without showing my age, I know James referenced his grandfather. I don't think I'm as old as him, but when I first started investing in equities, it was really difficult to get access to information about the company. And I think it was like a $4 minimum, trade that you had to do. That was how much it would cost you, and you'd get your statements by post, and you'd get your dividends in the form of checks. Wow. And these days it's the opposite problem, right? Instead of information being too tough to find, it's almost information overload. And what I found, it's interesting, I think both James and Dean mentioned customer behavior. I think in the industry I work in, which is predominantly like middle-aged white men, there's almost been this tendency to ignore like the Reddit crowd, which is the sort of gamification of investing in stocks. But I think this is the future. Wealth isn't reserved for the wealthy anymore. Everyone has access to information, everyone can trade, and that is driving volatility. So you can't just ignore it. Like it is how investing is changing.
Okay, excellent. And Rachel, I'd like to ask you a follow-up question. Like, if someone were to embark today on their investing journey, where would they start from? Like, how to assess like the current general financial situation and develop a roadmap to follow?
Yeah, that's a really great question. I think, James and Nadine are very well placed to chip in here because they have an overview of the client and customer as well. But I think just from a personal experience, the key is really honesty about your current financial situation, but also your awareness of personal biases and what your time horizon is as well. Because I think we all have a tendency to, we like to think we have a long-term focus until we have short-term losses, and that really changes our outlook. So I do think you need to be very, very honest about what your requirements are now, where you see your requirements in the future, and also just to have a real oversight of your portfolio. Like, one thing that we see with clients is people have a number of different advisors, multiple private banking relationships, and the private banks will actually be invested in the same products. So your risk is very different to what you think it is, because you actually have greater concentration than you're aware of. So I just think transparency and honesty about your financial situation and really seeking advice from someone else who can help you assess what your portfolio is and what your future needs are. So, and we all have these biases. I know James and I have spoken about this at length, about behavioral biases and endowment bias. You hold on to something that's been given to you like an inheritance longer than you should for emotional or personal reasons. And we all learn about, efficient market hypotheses and the rational investor, but let's face it, like we're humans, we're irrational, and we need to be aware of that. So I'd also, love to hear.
That I think that's a great point. But speaking of biases, I'd like to ask you, James. In his book, Psychology of Money, there's the author, Morgan Housel. He gave two examples of people. There's two sets of people. There's on one side, like people like Ronald Reed, who was a janitor and fixed cars at a gas station for like 25 years, yet died with tiny savings that have compounded into more than $8 million. And then the other type, there's like Richard Foscone, like he's a Harvard-educated Merrill Lynch executive who's had a super successful career in finance, yet became bankrupt following the 2008 crisis. So I'd like to ask you, what lessons to draw here, especially relating to biases that Rachel mentioned? Like, what are the lessons relating to saving, compounding, controlling expenses, like general attitude towards money, especially that it doesn't seem to be about how much Like, I would have assumed that the Harvard educated, the finance executive would know better how to manage money.
Yeah, I mean, it's a great point, and for anyone listening, I recommend the book highly because it really delves deeply into these different areas. But what I've kind of always advised clients over the last decade or so, and it's the responses that you get is quite strange. But I always say the strategy that you have around the investing is actually far more important than the type of investment that you pick. And they struggle to get their head around that, because it's so true. And in the book it talks about how the first gentleman, how long he's been investing, and he doesn't have the level of education, but ends up with $4 million, whereas the Harvard scholar, he's in debt, and it's because of the choices that he makes. And you've heard people say, it's what you save, not what you earn. And it's absolutely about long-term saving. It's about the strategy. It's not trying to be smart with it and time the market. It's working with, somebody having a particular goal, putting a strategy around it, and just trusting the process. And that is over a long period of time, is a tried and tested method that works, as opposed to someone because you'll never be, no matter how good we think we are or smart we think we are, we're never going to be able to try and time markets and pick the stocks. Yes, we'll get lucky here and there, but to do it consistently time after time and buy and sell at the right time doesn't work. So the strategy is one which works.
Excellent. Speaking of strategies, I'd like to ask you, Nadine, like what do you think of passive versus active investment strategies, and also relating to that, like what are some ways, general ways for people to generate some passive income, especially for like a working professional?
Yeah, no. Look, these are two different type of strategies, right? To put your money to work, and typically both would measure themselves against the S&P 500, just to track their performance. And just to summarize very quickly, so passive investing is about tracking the market, is about looking into the long term and making sure that we have a passive approach to investing. And as James was saying, it's about controlling emotions. It's about not being in it for the short term, because there's a lot of, it's emotionally draining, especially for retail investors. And while active investing requires, a whole lot of different level of market expertise and access to data, and even with that, the majority of investors, when they're actively trading, fail to beat the market. And ultimately, there was this research that's done over a period of 20 years that shows around 90% of index funds tracking companies actually beat and outperformed their active counterparts. So I can tell you that for us, from a Sarwa perspective, we still believe that the best way to actually build wealth for retail investors is to have this long-term, well-diversified portfolio of indices that can help you really put your money to the best use. And as you mentioned, to grow passive income properly, but also taking into account your risk profile, your risk appetite, and to make sure that you build wealth the right way.
Okay. But then when would active make sense for the normal, I mean, let's say not an active trader, like for a normal person, should they not touch, when could it make? I
wouldn't say they shouldn't touch, unless you're familiar with Sarwa. So Sarwa, we started as a robo-advisor. So the core program that we have is called Sarwa Invest, which is the hands-on long-term passive investing. But we did also launch Sarwa Trade, which is a zero commission trading platform. And the reality is we wanted to also give our clients the ability to buy and sell into things they strongly believe in, aside from the bulk of their money where they put it passive investing. So we have the majority of our clients that have two accounts, the invest and the trade. And
absolutely. I'm one of them. Yeah.
So it's also to actually have these alternatives and be able, but again, it all depends on your risk profile and your risk appetite. And we still, consider that the bulk should be in passive.
Yeah, no, that's a great point. No, I totally agree. I think especially if someone is not really, up to date or doesn't want to spend too much time researching and stuff, I think the active is, I think as humans, we like to, we like to be in control, and a lot of people would like to get, let's say, stocks for brands they can relate to or they just admire, and so there's definitely a use case for that. Great, thanks a lot, Nadine. Now, Rachel, I'd like to ask you, how does one's personal experiences growing up, especially if you grew up when there was, like, say, war or like a complete currency fluctuations or total collapse or war, or at the opposite, it could be like complete prosperity. So how do those personal experiences shape up their attitudes towards money, risk-taking, and investing?
Sure, that's a great question. I guess I'll start that maybe personal experiences and then looking at some other examples. But I actually went into finance like Nadine. I was multidisciplinary. I actually started as a journalist and then moved into finance in 2007. I actually got my job with Mubadala about a week before Lehman Brothers crashed in 2008. So I really started my investment career. I went into risk management because I thought it was recession-proof job. So I've always been, while naturally quite have a high risk tolerance from a financial perspective, I did start off quite risk averse, but obviously your personal experiences have a huge impact. And I think what we're seeing, and this ties into the retail investor and the younger investor coming to market, is that for a lot of millennials, they've never seen a stock market crash. I mean, COVID, obviously, there's been a lot of volatility, but even that was short-lived when you actually looked at some of the factors that were in play. And then along with the rise of that in the bull market, you've had cryptocurrencies, the ease of trading. So I think that's really given them high risk tolerances. And I guess just want to tie this into a point Nadine made about active investment strategies. I think that these come to the fore, and I'll just digress quickly and bring it back, but these come to the fore when it's an area where there's information asymmetry, and cryptocurrency or some of the newer emerging asset classes, you do have information asymmetry where it does make sense to pay a manager that might have more access to information than you. But otherwise, if you're paying a manager 2% and the returns aren't beating the market, then it's not really worthwhile. But also when you're taking, so just bringing it back to how culture and how you grow up shape your behavior. I think when you look at our parents' generation and grandparents that did grow up during the war, they're much more risk averse. So yeah, it obviously does have an impact. I know when I talk to my mum about cryptocurrency, I lose her within about 3.5 seconds. So
that's a great point. I can relate to that. Parents, always pushing on saving, because they grew up in very uncertain environments, and at that time there was war and all of that. So it was all about saving and never about investing. The concept of investing is very, alien. But yeah, it's probably maybe other parents who grew up, I don't know, in some other geographies who've had a very different, maybe experiences. They would be they would have they would raise their kids to have a totally different outlook. I think that's a very interesting point. How we see money is directly impacted by, our upbringing, our experiences, and general, the society we grow up in. That's great. So I want to move on and get a bit more into details and talk more about how to construct a certain portfolio and how to allocate money into different assets. And I'd like to ask you, Nadine, now the theme of this panel is about the future of investing in the era of longevity. So the rising life expectancy means that we will live up to 100 years or more. So how should someone's asset allocation change with age and with changing risk appetite?
I love this question. And I can bring it back to also women, by the way, because from an investing perspective, women now, lucky or not, we tend to live longer than men, right? But we tend to invest less. So it's something that I always, thought about as I try to push more of our clients, women clients, to join the platform. And I'm hoping to see, this number increase, is the fact that, again, when you live longer, that means two things. You need to start investing sooner, and you need to be saving more, and you need to account, a lot of different variables into your investment strategy. But when we talk about asset allocation, basically asset allocation, what is it? It's really the mix in your portfolio that can balances the risk that you take. So it's really having properly diversified assets that are also properly correlated. So when one is moving up, the other is moving down, and it balances. And usually the older we get, you would want ideally to take less risk, right? So that's why we say that age generally dictates the assets allocation. So I'll give you an example. In growth portfolios nowadays, you would have more stocks than bonds, but now, as we mentioned, you have more asset classes that are coming into play. So we do have alternatives also to how we want to approach growth generally. For example, I'll give you the example of crypto. Right, maybe by that time crypto will be less volatile. It is still, considered an asset that has some volatility, so it's more risky than other assets. But what's also equally important, I would say, is how you manage behavior and how you look into your earnings at a certain age, because these also play a major role. So, by the way, we do have a retirement calculator on our website that we built for these considerations. And I think it could be a very helpful use for anyone that wants to look into how much money they need to be working towards. But generally, I really go back to the 4 rules of investing that we generally have, which rule number 1 is always about start investing as soon as you can. We can talk about the rest of the rules later. About
So, cool, good. Thanks a lot. Thanks a lot for your input, Nadine. Now, James, you started off by talking about financial independence. So I want to ask you this one specifically, like how long does it really take to become financially independent, and how much money does one really need to have a great quality of life?
Yeah, I mean that's always, I guess, the $1 million question, right? And it really does vary on the individual. A lot of people, when we start working with them, and this is a question that we would ask and start to go into their wants and desires and whether they think they're going to retire or what type of lifestyle they want. And it's difficult. And going to what Dean said, one of the best things to do is just to start, because whatever their goal is when we first meet with them, it's always different at the end. It evolves. But as an average, from speaking with people, if they have an income of say $5,000 a month as an income that's coming in passively, you can have in today's money a good standard of living. Now, we always say there's 2 ways that you can build that. One of them is if you do it through the markets, you can build it up comfortably with the average salary in say 20, 25 years. But if you start to add property, if you're investing into property, which we encourage, and you can do that, you do it correctly, you can almost half the time that it takes you to reach your level of say $5,000 a month as an income. So that's kind of a general rule.
Okay, excellent. Thanks, James. And Rachel, I'd like to ask you if there's a certain recommended allocation strategy that you advise people to use in this, especially in this uncertain environment.
Yeah, so I think you need to assume that every investing environment is uncertain to some degree. I mean, especially if you're taking a long-term view, the market obviously is cyclical, so it will go through cycles. But as the others have pointed out, it does come down to your short-term and long-term goals. And I liked James's point that it's really the strategy that will guide your returns more than like the timing of the market and the individual asset allocation.
Well, if you find something, let's discuss, but that sort of range is.
Oh, let's just mute. Yeah, so I think you, as well as looking at the asset allocation, also consider your liquidity needs. But I think that, and I don't want to just harp on about cryptocurrency, but we advise clients to invest a small amount in cryptocurrency, Bitcoin as a store of value, and start off with, maybe just 1% of your portfolio. But I do think that the 60-40 allocation model, equities, bonds is kind of dead, in my opinion. There's so many other strategies and things out there now. And I see that there's a question from Stefano as well about considering alternative investments and illiquid investments. So I think when you're building your optimal portfolio, it is really important to consider the liquidity of those investments too. Obviously, equities, cash, bonds, listed things are very easy to liquidate. So just to consider that when you're building your strategy too.
Okay, great. Thanks. Actually, on the topic of alternative investments, so I want to ask you, James, like with the emergence of the new asset classes like the cryptocurrencies, NFTs, the recent metaverse trend, so should one's investment strategy change?
Yes, I think we should all be evolving with times, and what Rachel's talking about there about having an allocation, having the percentage definitely makes sense. I think where it comes down to is do you do it individually or do you use an expert? Because yes, you can have a percentage of allocation in cryptos or NFTs or alternatives or any form of more aggressive portfolio. But if you're doing it on your own and you're trying to pick it compared to, say, going to Rachel and Skybridge and investing with them and using their expertise. So I think we should always be evolving, because that's how we learn. A lot of clients with me, when they invest with me, there's a lot of trust involved. but also they want to learn, and we're sending articles and updates so they get educated, and the more they understand it, the more comfortable that they feel. So yes, I do think the new trends make a difference. It should be something that we all kind of get on board with. But it's, I guess, a safer way of doing it would be, if they want to merge into these spaces, is to go through the management companies and the funds first. That might be a nice way in.
But would you go with Rachel's approach? Like, you would recommend like a small allocation of a portfolio to go there, or you know, or it depends on a case by case?
It's always case by case. I mean, as a general rule of thumb, to have allocation to it, yes, absolutely. It's just about exposing, you know, and as Nadeem was saying, you know, as one goes up, one goes down. I mean, it's just diversification, and what percentage that is, I think, just depends on the individual, how much money they have. Are they putting all of the money in now, or is it something that they're going to be adding in later with time? Because how they're investing changes the risk strategy as well.
Okay, great. So on that, I know that the Sarwa platform, Nadine, it has, you know, like an investor can allocate a certain part of their portfolio. I think it's up to a limit of 5 or to 10% in, you know, in an kind of like an index tracker relating to Bitcoin. So I think it gives some exposure to, you know, to cryptocurrencies. But you know, if someone wanted to be, you know, as you know, there's like tons of crypto coins like popping up frequently. Like, is there like a crypto robo advisory service for those who want exposure to crypto, but you know, they don't want to monitor and trade daily?
Yeah, I mean, of course, as you mentioned, Rawad, is the fact that we have this portfolio, right? So that actually brings me to rule number 2, 3, and 4. So and rule number 2 is diversification. As James was mentioning, diversification is extremely important, just to make sure that you're not putting all your eggs in one basket, and you have, you know, different asset classes where you're investing in. So the crypto portfolio at Sarwa has, you know, stocks, bonds, real estate, and exposure to Bitcoin. The exposure is 5%, and you can really choose that. So that's for people who don't want to monitor daily, who don't want, again, to have emotions playing in. And that's really, again, number 3, rule number 3, which is controlling the emotion. And this is where, you know, tech platforms and specifically the hands-off investing arm comes in, because one of the biggest mistakes investors do in their investment journey is to be emotional about their investment, especially when they already have a plan in place that's really, you know, reflective of their risk appetite and risk profile. Because, you know, the market moves, and market movement creates panic. So when you use this hands-off approach, you put it aside and you forget about it, and you don't panic in these times of turmoil. So this is where I would say Sarwa Invest comes in. Now, to increase exposure to assets such as, you know, Bitcoin or other cryptocurrencies, then you can add that, again, let's say if you're using a platform like Sarwa, through trade. And we do have access to advisors, so you can actually schedule a call with the advisor that can give you exactly these increased allocations based, as we always say, on your risk profile and your risk appetite.
Okay, but are these like ETFs that would ETF-like products, or?
Oh, yes, you do have that. You have like trust, similar to trust, as and ETFs that are coming into the market, and yeah, absolutely.
Okay, excellent. Thanks, Nadine. Rachel, moving on to Rachel, I want to ask you, like, what are some of the metrics that one should use for alternative investments? Thinking of metrics to assess those investment opportunities. Example, let's say for ESG.
So, well, ESG is a whole different discussion topic in itself, but I guess some of the approaches are also applicable to alternatives in general. So I think when you're looking at ESG, it is a challenging one, and it depends on your approach. So, for example, private market investing, obviously, you know, by their nature, they're less transparent. And so being able to apply these consistent metrics can be really challenging, but I know there are institutions locally as well that are working on creating a more standardized framework. Obviously in the public markets, it's a little bit easier because data is transparent. And I guess, you know, the easiest approach to say ESG is the exclusionary approach. So you exclude certain stocks that you see as bad. So, you know, gambling, weapons, oil, etc. But in my view, the better way to look at it is actually to invest in a good company and make it better, rather than just excluding companies that you might perceive as bad. I also think with ESG that a lot of the times everyone focuses on the E because it's more easier to measure. They focus on the environmental impact and they don't really look at the social or the governance. And we see this a lot in cryptocurrency and Bitcoin in particular. A lot of the pushback, and Elon Musk has been very vocal about this, that Bitcoin mining is, you know, dirty for the environment. It uses coal power. You know, you can run a small country on the power used to mine Bitcoin. But what that side of the argument ignores is the social and the governance aspect. So the people that are saving billions of dollars a year and not paying remittance fees and using cryptocurrencies to transact with one another. So I think when you look at metrics for ESG, just, I guess, know what you're actually looking at, like know what your strategy and your mandate is before you actually look at the assessment part. But please don't forget the S and the G, because they're important as well.
Okay, great. Thanks a lot, Rachel, for those insights. One last question on the topic of alternative investing. I think, Nadine, you mentioned stocks, investing in stocks, investing in bonds, as well as crypto. I'd like to ask about angel investing. What do you think about it, and how can people invest in this asset class?
Well, I think angel investing is great. Not only are you supporting someone that's building a business, but you can also, you know, get in on, let's say, a great potential growth story at a cheap price, right? So typically, angel investors, they come in at seed level or pre-seed level in the life of a startup or business building. And I would say the majority of entrepreneurs rely on angel investing to get, you know, their idea off ground. And angel investors can be silent, can bring strategic value. They can be typically their immediate, you know, family and friends from the immediate network, or can be actually accomplished entrepreneurs. So I believe that angel investing is great for two reasons. Why? First, it's social impact, and second, it's also a good investment if, again, you have the right risk profile, because it's high risk. So high risk, high return. But I would say how do you actually do it is you have to make sure that, first, you have to make sure it's for you. You have to make sure that you're, you know, jumping in with the right state of mind, and with the acknowledgement that it could be high risk. You could actually lose your investment if the company doesn't take off. And second, like, make sure that you do your due diligence, that, you know, you take your time, either yourself, and if you don't have time, then just associate yourself with a network or join an investor community. You know, you have angel investor groups. Let's say here in the UAE, you have, for women specifically, there's WAIN, Women Angel Investor Network, and there's DAI also. So there are, I don't want to keep naming, but generally, I do believe it's a good idea if you have the right risk profile for it.
Okay, excellent. So James, I want to ask you, like last year, we saw how social media was driving up stock prices, especially with Reddit and the meme stock. And like, I mean, we saw GameStop, that's a case in point. So the question is, how much influence do you think social media will continue to have on investing?
Yeah, I think massive. I think we underestimate the power of the impact of the markets from customer behavior. Again, before, we didn't really see this because we didn't have It's down to the access really that the consumer has. So, I mean, if you take, for example, COVID last year, in our lifetime, this is probably one of the biggest things which has knocked the markets, because life was so uncertain during that period of time. So for us, it was almost like a World War II. That in itself had enough momentum to knock the markets by probably 40–50%. Now, in previous years, that could have taken 5–10 years to recover. But what happened is, and this is where the technology now has advantages and disadvantages, because it's just filtering information to the end users. And at that point, it was all negative. So markets was dropping, and it's only dropping because people are selling. So everyone's just reacting. And then it reaches a point where people say, actually, it's now a sensible time to get back in. The markets are really cheap. There's a discount. There's a sale on. When do we go buying? Well, now's the time to buy. And that's why we saw the V-shape recovery in the markets. And it was condensed probably with a 3-month, 4-month period. And then we had the biggest positive pull out of the market that we've probably seen in the last decade, because it was then everything going up and up and up, and technology was changing. So it has advantages and disadvantages, and I think it shows how resilient the markets are. That as we get a drop, if something else happens again in the future, which it will, because it's real life, it will reach a point where people say that there's a discount on, the markets are cheap, and everyone will start to get back in again. So I think it's going to play a huge part in our future.
Great. Thanks a lot, James. I'd like to end our set of questions with asking everyone among our panelists if there's any specific books or blogs that you would recommend when it comes to helping people get better with money. Let's start with Rachel. Any specific books or blogs, people to follow that should hopefully help people, better manage money, better invest, better understand risk and reward?
Sure. So one of my favorite books is The Intelligent Investor by Benjamin Graham. And what amazes me about that, it was written so long ago and still has a lot of relevance. One book which might not be helpful but is interesting is called Lords of Finance, and that looks at the role or impact that central bankers had on or can have on the financial markets. And then just looking at cryptocurrencies specifically, one thing that I struggled with when educating myself in this space, and tying back to James's point on social media, is there is so much information out there. It's very hard to find like someone that gives a balanced view and gives both sides of the argument. So from a cryptocurrency perspective, I really recommend the Bitcoin Standard. And there's also a subscription-based TV service called Real Vision TV, which has a free cryptocurrency portal. And they give a balanced view, which is very, very hard to come by in the cryptocurrency space. So those would be my recommendations.
Great, thanks. Any recommendations that you want to add, Nadine?
I honestly think these are great recommendations. Also, there's a book that I really like, that Andrew Hallam, which is someone we really respect.
Yeah.
Launched very recently, called Balance. I really like that book. I just read it.
Okay, great.
Really good.
Thanks. And what about you, James? Anything to add? Any recommendations?
I think, the Psychology of Money book is great.
Psychology, yeah.
I've always liked one of the first books that I started to get into from an early age was Rich Dad Poor Dad, which is very heavily into property, but the idea of having an income and not working for the money. But in terms of, I look at Seeking Alpha and Yahoo Finance for any information and updates. So that might be something that's always good to download and look if for the more active people that are wanting to get up-to-date information on. Which
one is that? Sorry, James, on the last point?
Seeking Alpha, and then just Yahoo Finance.
Yeah, cool. So great. I'd like to add a couple of suggestions from my end. Like there's this book that I'm gonna put it on the chat for everyone. I think it's quite an interesting book, like the Zurich Axioms. General rules when it comes to investing. I think it's a very short read. It's like less than 150 pages. It's a very basic, yet I think there's some really good lessons in there, especially for people who are getting started on their investing journey. Another, we talked about angel investing. I think this thread is particularly insightful. Like, it has a lot of insights, like what worked, what didn't, from someone who's done like investments in, he mentions 140 plus companies. So I think if people are interested in understanding better the odds, how to best choose investments, and the main learnings, I think it's quite interesting. And for I think, James, you were talking today about selling when the market is down, and how to react and how to act on it. And I think this is one of the main messages also from Sarwa. They keep on telling people, like, the time you're invested in the market, that's what really matters more than timing the market. I think there's a very interesting memo. They usually write a lot of very interesting memos on that topic, but this one in particular is relating to what's happening now in the markets. It's about selling out and how you cannot time it, and they make some really interesting arguments. So I think if someone wants to also check this out, I think it will be interesting. They've been like posting very insightful memos for the past I don't know how many years, but in particular relating to exiting the market during those turbulent times, I think this one is quite interesting. So I think on that, would like to check if there's any question from the audience. Anyone would like to inquire about a specific thing, or ask one of our panelists. So I'll just wait.
Robert, I've just seen a question came up on my chat, but it was in a direct message. I thought that it was in the chat. So it's from Stefano. Thanks for your question, Stefano. He's asked, can anybody talk about how alternative investments, especially more illiquid ones, are changing the weight of the asset allocation of investors?
Okay.
And I'm happy. I'll just maybe I can give some views from our side on that. What we've seen. So Skybridge was originally a hedge fund investor, so that obviously has varying degrees of liquidity. But we recognize, and this is one thing I love about the group, that fund of hedge funds is actually a dying business, or not growing as fast business, just because of the move to passive historically over the last few years, and active managers not generating returns to beat the market. But one thing we've started doing recently, which has really been demand driven, is doing more private market deals, like the pre-IPO deals, which from a liquidity perspective, that's how we're comfortable, because that time to IPO is obviously shorter. So we will invest in later stage private markets, but not yet at the stage where we're doing early stage private markets. And I don't know, Nadine, if you can maybe share your views, because I know you look at more on the angel and VC side. How would you sort of weight that within a client's portfolio? What would you recommend there?
I mean, I guess my answer is going to be just a general one. It's a case to case, and it really depends on the person. Because some people are looking for that risk premium, while others cannot afford that risk premium. I don't know if that actually answers the question.
Yeah. Cool. That's great. On the question. So the question was about alternative investing. I wanna go back perhaps maybe to the more traditional forms of investing, and they were two general trends. There was like value investing and growth investing, and the question is, should one person choose one camp to be in exclusively in, and and you just stick to it? Or is it is it like more like a trait or a behavior that one should change with changing economic cycles? So I think questions for James or Nadine, whoever wants to pick this one.
Yeah, I mean that's another really good question, and I think to answer that, before we started, we were between us all, we were just having a little chat, and we were talking about the markets, because now we've seen a recent dip over the past few weeks, and I think this goes back to the strategy as well, that anybody that's maybe a little bit nervous about the markets and maybe entering in now, and the whole timing of things, and do we go in and try and get value, or do we just put it away? Dripping money into the market, and what I mean by that is as opposed to just putting a lump sum in and waiting, continually adding it into the market and averaging, and you call it dollar cost averaging, and it de-risks the portfolio so much more. It handles volatility much better, and I think that as a strategy, you can afford to be more aggressive, and you're going more for the long term. So the strategy, you work with a company, and you put a strategy in place, you average in, and you can go more for the growth type of investments. And then if markets do dip, you might say, because of the opportunity, we put a little bit more money in than we normally would, and that is a proven way of getting growth, reducing your volatility, and getting the returns that you want.
Yeah, and then forgetting about making decisions every single time. You just allocate certain amount at a specific time on a periodic basis, and you just keep on following on it. Great, yeah. Thanks. So Nadine, I wanted to ask if would you be able to highlight any mega trends, any emerging themes that are happening right now in the whole economy that are relevant for investors, or investors want to be? Any, I mean, we're looking now perhaps at, what the Fed is doing, but, are there any other trends that are happening that one should be particularly aware of?
I think there's a lot happening, to be honest. Again, going back to what James was saying about the market conditions right now and behavioral investing, the reality is we are, pushing a lot in terms of education of what to do in times of these market volatility. And our view is also, just to top on what James was saying, that if you have your emergency fund figured out, if you have that money set aside and you have money saved beyond the emergency fund, then the best way to do it is to put that lump sum into investing right away. And again, it depends, the allocation, to go back to what Rachel was saying, the allocation would depend on your different risk profile, risk appetite, but being in the market is extremely important. Now, that's one thing. In terms of trends, but also for emotional investors, I would go back to what James was saying. If you are an emotional investor, and you're really scared of what's going on in terms of market volatility, you don't have to put everything in one go. You can actually dollar cost average it and then go slowly and bulks.
Okay.
But trends, I would say generally beyond, the market trends, there's the investing trends that we're seeing, especially from a younger generation, Gen Z and beyond. I have kids, and I see now amazingly how they're interested in investing. And there's the whole metaverse, there's NFTs, there's the meme coins. You have a lot of options nowadays. But if we're talking long term, it's important to actually wait and see, until things settle down a little bit, unless you, again, have that risk appetite in place.
Yeah, or you have very strong conviction about, whatever, the metaverse, or, some specific
but diversity.
Yeah.
Everything in one place. That's very important.
Cool. I think we've got a follow-up question. I think this one's for you, Rachel, from Stefano. So the question about the allocation and alternative investments, he's asking if the alternative investment portion, can it weigh up to 30% of a portfolio?
Well, again, I think that comes down to liquidity requirements and also risk tolerance. You could argue that the public markets have been overvalued or very richly valued recently, and companies are staying private much longer as well. So the actual risk profile of the company has changed, but the risk profile of the liquidity hasn't changed because it's still much more difficult to get your money out. However, having said that, these days with the onset of technology, and you can actually do secondary trade, so it is possible to liquidate a position in previously what might have been very challenging to liquidate. So I guess short answer is it depends, but from a personal view, if you take out cryptocurrency, then I have most of my holdings are in private markets or illiquid assets, because the companies I love, the stories that I believe in, I have high conviction, and I have diversification within the portfolio, but on the private market side, that's my high conviction approach. So that's what I would say on that one.
Excellent. And there's a question from the audience about real estate investing. I think if James or Nadine would you like to pick this one? And so the question is, what type of real estate investing is best? How to really get exposure to real estate? What are the different ways to do that?
Do you want to go, Nadine, or do you want me to handle this one?
Go ahead, James. I can just add.
Okay. I mean, for me, I would invest in developed markets and something which has law that protects you. But you've got to make a decision at the start. Is it for you to live in, or is it for investment? Because if it's for investment, you want to remove emotions from it completely. It's all about the numbers. And then are you going for appreciation and you want the property to grow, or are you going for a long-term yield and it's kicking you out income? So you've seen obviously in Dubai, house prices have gone up over the last 2-3 years. Sustainable, no one really knows. You've got to look at the build quality in the UAE, how long are these properties going to last, and they're building at such fast rates. So, if you look at more developed areas of the world and you look at the US or Europe, the UK has really good laws around property and protecting the owners. Then you stand a greater chance of getting long-term appreciation levels and long-term income from them properties. So that's probably what I would say on it.
Great, thanks. Maybe last question, maybe to you, James, and then the question is about valuations. I mean, we talked a bit before about the meme stock. So the question is, should there be less focus on valuation and more on understanding social mass behaviors? Should one start understanding people more than looking at financials of companies to value a company?
Possibly, yes. Yeah. I mean, in the past, it just used to be always about the balance sheet, looking at P&L, looking at the demand, looking at the individual components of a company. And now look at, you mentioned earlier GameStop, it's more about how is the public going to perceive the activity of that particular company. I've seen some particular companies that have had great paths and graphs for like a 2-3 year period of growing at 5-10x. And from that point, they've continued to grow. They've won more contracts. They've got more regulation, more certificates, and based on them formulas, the company should have continued, the share price should have continued to grow. But because it was manipulated through social media, drops 70-80%. So there's definitely
interesting more questions, but I mean, there was one question: if you want to start investing small amounts for your children to give them a portfolio when they're early adults, what do you suggest? I think that's quite an interesting one. If someone has a 10-second answer, that would be great. Otherwise, we're a bit running out of time. Who'd like to take this one?
Save your age as a percentage. That's all I would say.
Okay, cool.
It's a good rule of thumb.
Great. Thanks a lot. Thanks a lot for our great panelists today. Thanks, James. Thanks, Rachel. Thanks, Nadine, for being with us tonight. Thanks, stuff that you can apply to invest better your hard-earned money. And on that note, I'd like to hand it over back to Wulan.
Thank you, Rawat. Thank you, everyone. Like, on behalf of London Business School Women in Business Gulf Association, I would really like to thank you once again to all of you for spending the time and joining our sessions today and for asking interesting questions. I really hope you find this session informative, and thanks a lot to all of our guest speakers. And the moderator for the investing is actually the second part of the series on the path to longevity. So you can follow LBS Women in Business Gulf Association on LinkedIn to find out more about our next events. If you would like to get in touch with us or to find out more about the panelists, you can email us on lbs.gwba@gmail.com. Thank you so much, everyone, and have a lovely evening.
Thank you. Bye-bye.